FirstCry is a brand synonymous with childcare, new mothers and baby products in India. Founded in 2010 by Supam Maheshwari, it's become a category leader. And I must say, it's a hit with new mothers. I'm a mother and I can personally vouch for FirstCry. It's one of my go-to apps. But Supam, the question for investors is, when do you turn profitable?
This is a very large industry in the first place. We are addressing $34 billion. India creates 26 million babies a year. And we will be $68 billion of the size of the market by CY28. And with such a large market which is growing at a 20% CAGR, it is bound that we will have a journey of our own. If you look at our India multi-channel, it's actually already profitable. We have been profitable for last 4 years in the adjusted EBITDA basis. Our last year adjusted EBITDA was around close to 8.8% for FY24 for our India multi-channel business.
Let's talk about your gross margins. Your gross margins have ranged between 30 to 35%, which is lower than the direct retailers. Any of the listed retailers, they all have minimum gross margins of 40%. Why is yours lower? And you spoke about improving gross margins.
So we have been, obviously, all these years we have been improving gross margin. If you look at our gross margins for last 2 to 3 years, they've been improving year-on-year basis without having any year that we have not improved our gross margin. And this will be a factor that we will be able to improve our assortment mix, our curation, our investment in brands, our investment in our home brand strategies, which essentially will mean that we will be able to continue to compound our gross margins over a longer period of time. Our journey has just begun, although we may look like 13 years.
So 40% plus gross margins is possible, right?
Look, others have done it. We should be able to do it, but we will get there in our journey as we go along. I can't say for the future, but we will definitely strive to get there. It's not something impossible.
Okay. Let's break up your business into India, which is about 70% of your revenues. You have international presence in UAE and Kingdom of Saudi Arabia. And then you have a house of brands, a D2C investments in 21 entities, which you house under GlobalBees. Now, India revenues in particular. Now, FY24 appear to be a bit of a slower growth for you. Reported revenues have gone up by just 7%. Your EBITDA margins are between 8.5% to 9%. Again, lower than the listed peers. What can you guide on the India business?
So look, we are not at a steady state. We are a new age, ecosystem modeled retail organization today. We believe that we will be able to, continue to grow in India as well as international and as well as in GlobalBees, because some of the other adjacencies that we have done are very recent, very young. From a profitability standpoint, obviously we have grown meaningfully in India from, as I said, from 5.9 to 6.2 in FY23 and 8.8 in FY25.
That's
if you look
margins.
at our that's adjusted EBITDA margin.
EBITDA margins, yeah.
Because that's how you should look at the company, because that's the operating adjusted EBITDA margins, and this will continue. And we are not at a steady state. I can only say,
so what
when you compare with listed,
for the India
look,
business?
Other listed players are at a very tall EBITDA margins, okay. And we aim to get there. We are in our growth. We will be investing out of the use of proceeds that we will raise from the public markets. We will invest behind our brand, our technology, our supply chain. Getting more customers, and with that we believe that we will be able to continue to expand our gross margins, our operating leverage, and through our marketing cost and so on and so forth, and essentially driving up the operating. Absolutely.
So what are tall EBITDA margins that you're comparing?
Look, they are in high teens. I mean, the good companies, we always sort of benchmark ourselves to leaders who have done there and have become, So
aspirationally, which is that company?
Well, there are good companies. There are all good companies where...
Name two.
I like in person, companies like Page Industries.
Okay.
Yeah, I mean, that's one company I believe they've done very well in terms of EBITDA margins. Even for that matter, Trent.
UAE and Saudi Arabia, because that is bleeding for you. That's the biggest drag for you at the bottom line. EBITDA losses in the international business was 140 crore in FY24, 120 crore in FY20. How long will it be loss-making? Is there a turnaround plan? What is your turnaround plan?
We started in UAE in October 19 and in Saudi Arabia and Kingdom of Saudi Arabia in August 22. And we have not even finished 2 years.
Yeah.
This month we will finish.
So how long does it take to turn around?
So it will be a couple of years as the journey has been in India.
So India took how long for you to turn around?
Well,
if
India
you want to
took,
copy the same playbook.
Well, India would take a little longer because we started from scratch,
okay.
right? And in international markets, it won't take that kind of long time because we took all our strengths at a platter, right? And then actually we have done all, the hard work of building our supply chain, our tech platform,
5 years,
brand.
10 years from now?
No. I don't think that's too long.
It's too long.
It's
not
too long.
even 5 years. You should turn around before that.
Well, much earlier than that.
Next year?
No, I won't say that, but
okay.
but yeah, we'll get there much faster than what it has taken India. India, it took us almost nine and a half years to get to a operating break-even. I think it should take much less.
You spoke about how you're replicating India's playbook in UAE and Saudi Arabia. But India is a very unorganized retail market for childcare, while GCC is a very organized retail market. So in that sense, it's different. What gives you the right to win? So, and if you want to also comment on your top line, because it's small, it's 750 crore as of last year. What's the growth runway for you?
So look, although India market is very unorganized, 86% of the market is unorganized, and you're right on that. While unorganized is becoming organized, we play in the organized sector. As India per capita, will increase over time, as we all know, with the growth in India, we will see a lot of unorganized becoming organized, and therefore, being the largest organized player, we will benefit the most. And we have taken the same playbook that we will take from India to Middle East. While we are operating in the organized market, in UAE and KSA, it's all about organized market. Yeah. And within that, the playbook will remain the same. So we will get a much better tailwind in that sense to be operating out of the large organized market with the same playbook of having a large online. And as of today, we are 100% online business in both UAE and Saudi Arabia. And as a part of use of proceeds, we'll be putting out some 12 stores in Middle East and growing our sort of an omni-channel, multi-channel story. As you take along all our India moats that we have built, we'll be exactly replicating it. We have replicated that over a period of time. So we feel very confident of our right to win, what we have been able to deliver in India.
Got it.
And in Middle East as well.
So you said the international business should turn around soon. 5 years is too long, but maybe 1, 2, 3 years down the line it should turn around. But what about the steady state EBITDA margins? Is it also in mid to high teens like it is in India over there?
Well, look, I would say, great companies will find a way to deliver those margins.
So the aspiration remains the same?
Yes.
Got it. Let's talk about GlobalBees. That's the third leg of your business, which is a house of brands where you make investments in D2C companies. Now, what's interesting is it's founded by you, it's a unicorn, but you decided to incorporate it within FirstCry. Now, the question here is, why did you do that? Because it's an unrelated business to childcare. You've got investments in home decor, you've got investments in jewelry, gym equipment kind of companies. So why did you choose to do that?
So look, essentially, it's a great question. So look, we had a great competency that we had built in FirstCry ecosystem for a very long period of time of building home brands. And we built global supply chain, global sourcing capabilities, we built tech platforms, we built brands, capabilities around digital marketing, supply chain, all of that what we built, data science, we felt we should be able to replicate in other categories which are beyond mothers, baby and kids category. And that therefore we went back to our shareholders and our board, got their blessing, incubated a company, GlobalBees, in May 21. And look where we stand, building in these 4 categories of home utilities, appliances, lifestyle and BPC, HPC. Today we stand at 1,209 crores of FY24 full year revenue and adjusted EBITDA break even already in 3 years.
Okay. And what's the aspiration here?
Look, last year we grew 35% year on year.
Okay.
And the market CAGR, if you look at our industry report, is growing at a 34% CAGR for next 4 to 5 years. You can make a good guess that we should be able to do.
At least meet the industry growth rates, if not beat it.
Well,
and on the EBITDA margin, you've just broken even.
Yes,
Can it go to double digits soon in, say, 2 years?
I won't be able to comment on how long it will take, but we will definitely be, improving from where we stand over next few years.
FirstCry stake in GlobalBees?
50.23% on a fully diluted basis.
50.23. And the balance is held by private equity players?
Yes, some of them, yes.
So I'll tell you a risk which has come into the market is that PE players tend to churn. They have a life of their investments. So at any point of time, if a PE investor wants to exit, will FirstCry look to increase their stake? Because if they do, it's a cash outflow.
Look, FirstCry doesn't have any commitment. No commitment, no obligation. And these are very respectful names that we have taken on our GlobalBees cap table, and I'm sure they will be more interested in keep compounding their wealth here with us than finding another alternative.
So you've spoken at length about your margin aspiration, right? Getting to where other listed retailers are, mid to high, a bit, teen kind of margins. What about on the top line? From 25,000 crore, you've been growing at more than 20% for the last few years. Is that the historical growth
so
rate?
our revenue is 6,400 crores.
Yes.
And we have, last year we grew around close to 25%. We believe we are operating out of a $120 billion TAM, which is very, very big. Very rare, opportunity for teams like us, management teams like us, to operate out of a $120 billion TAM, which is in India, which is $68 billion, UAE and KSA $11 billion, small one preschool is $8 billion, and our GlobalBees is around close to $35 billion. So we feel very excited. We're an insignificant player in that $120 billion TAM. Although we may be the largest in India, multi-channel, in the India mothers, baby and kids ecosystem, but we're still insignificant. So we have a huge headroom to grow for many years to come. So feel very excited. Hopefully we'll continue.
So what's been the past 3 year historical top line growth rate?
We have been at a console level, we'll be at least 30% plus.
Is there any reason to believe why this will not continue, or it should continue?
Well, I can't speak about the future, but I'll say given our strengths, given our industry CAGR that is already high, we should be able to do justice to those numbers. And
the $120 billion TAM.
Yes.
Okay. So in this, since we're talking about the future, you have more than 1,000 stores right now. You're raising money, close to about 1,600 plus crore. Some of it will go in expanding your store count. How many stores are you looking to add on an annual basis to capture this TAM?
So if you look at our RHP, you will see we are adding around close to 350 Coco stores in next 3 years alone. We will continue to add more stores as we go along.
What will be the breakup between India and international?
International will be just 12 stores.
Just 12 stores.
Just 12 stores.
Okay. And for the benefit of our viewers, COCO stands for company owned, company operated, which is different from the asset light FOFO, as they call it, franchisee owned and franchisee operated. But
I must say that we have 680 stores which are franchisee owned and franchisee operated. They have been our great partners in our journey. So 68% of our stores are FOFO, asset light totally, no capex, no opex, that's how we have been operating since day one. And Coco has been a recent addition.
So your online mix was more than 80% last 2 years. This year I think it's come down to 76, 77%. How is the online-offline mix going to change when you increase your store count?
No, actually not. So I think maybe there's some confusion in the data that you have seen. If you look at our online-offline mix in India, for example, it has pretty much remained constant.
81.6% in FY22, it was 77.4% in FY23, and it's at 76.9%, so a slight decline.
Well, you are looking probably...
India operation.
Yeah, so should not look the data for the FY22 because there was a COVID year. COVID year had some, stores operations were during COVID were hampered. So if you look at from a steady state for last 2 years, it's around almost 76%.
77.
We believe that our online story as well as our offline growth will compound at a natural curve in terms of both growing meaningfully, and therefore this ratio should not change much.
One of the levers is increasing the increasing the revenue contribution of your own label, Baby Hug. What does it currently stand at? Do you have an aspiration to increase it in terms of the revenue contribution, and what can that number look?
We have 7,500 brand partners. that we are working, and we have our own home brand portfolio as well. Our home brands is a meaningful share in our portfolio today.
How much? 50%? Is that a fair assessment?
I won't be able to share exact number, but it's a very meaningful number. Since our home brand share is meaningful, Baby Hug is a large part of our home brand, which is also our home brand. Usually you would expect that home brands, typically since you will do right from manufacturing to retailing, you will have a higher margins on the home brand compared to the third-party brands. So you'll continue to over-index on your margins as you grow along your home brand story.
Your market share is currently 2.5 to 3% in the India childcare products and 16 to 17% in the organized India childcare products. How has this market share changed, say, in the last 1 year or 2 years?
Look, it will keep changing as we grow along, because one, we're in the large TAM, and all our strengths.
Has it gone up, your market share?
It will gradually inch up, is all I can say. If because if you look at the industry will be also going at a 20% CAGR. So we'll do better, hopefully, and therefore we will continue to improve. And as we have talked about, we are the largest shopping destination already. 1,000 stores will become, as we said, we'll be putting out 350 stores in the next 3 years in Coco alone. And with all of our the strengths of our Coco stores, FOFO partners, our online base of millennial mothers, and our distribution channel, which also has recently started, where we're taking our home brand products to pharmacies and groceries where young parents can buy their products. Some of the products like a diaper or a lotion or an oil and so on and so forth from the pharmacies and groceries coming back to us, buying the larger range of Baby Hug products back onto our channel is like a closed ecosystem story that
But you're in that door only for 12 years, right? Because you are catering to products from the age group of 0 to 12. After the child turns 12, that mother is out of the door.
That's correct.
So is it tough for you to retain customers, and what is the strategy to acquire more customers?
So, great question, Reema. I think, look, first of all, we have operated, this TAM itself is so big, as I've been saying again and again, within the 0 to 12, right?
$68 billion
$68
in
billion
India.
by CY28. That itself is only between 0 to 12, right? And having said this, we are insignificant. We are like 2 to 3% share. So we have a huge headroom. Only 14% of the market, 16% of the market is organized. So there is also a huge headroom to the organized market to become bigger as the India will, prosper. Now,
But do you feel the competitive heat? Because when a child becomes 6, 7, he has the option of going to other stores, like say Agio or buying from Myntra, Zudio, for instance. So how is competitive intensity, and how has discounting changed for you in the last few years?
So look, if you look at a competitive intensity, we have played on our strengths for a very, very long period of time. All these players have been around for more than 10 years. Most of them have been around for more than 10 years, or at least 7, 8 years plus. And they're all having as much capital as you can imagine to deploy and to push and to do what they have to do. But we have been very laser focused in building solutions to bring joy to young mothers and young parents, because we are in the business of building trust with mothers. If we are able to deliver on building and compounding that trust with mothers, mothers will only be with us like you, who will shop with us, not just for as a multi-brand retail platform, be online or offline, but at the same time also come back for shopping some of the curated brands of 7,500 brands that we have, plus our home brands. That way, mothers will have two main reasons to come back to us for this curation, for this trust. Our supply chain is very unique. We are talking about 900 plus contract manufacturers that are making with us. Integrated, there are 82 warehouses. We deliver 47 cities, same day delivery, 1,000 plus cities next day delivery. This kind of a supply chain hardly exists in the country, and in the babies and kids market, you can imagine it's very rare to find.
You worked on a lot of adjacencies which have added value to FirstCry's growth, whether it's the international presence or incorporating GlobalBees or even expanding the age group for which you cater to right now. What are the moonshot ideas that you're working at?
Look,
it's not for the investors today, but I want to know that in your dreaming big, what is it that we're looking at now?
Look, when you dream big, you have to also, make sure that you are laser focused on execution.
That's fine.
No, it's very important, Reema.
This baby is going to grow up fine. Tell us what else you're working on.
So look, I think we will have opportunities as we go along. Although this $120 billion TAM is very massive for us, We will be growing our distribution channel, quite meaningfully as we go along. Because there are millions of retailers, pharmacies and grocery where we can have these products where consumers can, young parents can buy from that demand. India has 3 demand pockets, right? Online, MBO, EBO, and third is retail, GT, right? We are very less present in GT because this journey has just started for us. So this is a very big growth area for us. Like we will add more stores, like we'll continue to add our online through investment in technology and brand. So for us right now, instead of taking more moonshots in other international markets or other areas, I think today, if you ask me honestly, we believe and our management team is fairly excited to just remain focused on 3 things. We will continue to focus on India multi-channel, our international UAE and KSA, and our GlobalBees. These 3 itself will give us, bountiful of opportunities that we really, want to assimilate and create value, not just for, solutions for young parents and our customers, and also for our shareholders.
Was there ever a time when you thought that this is too tough and I'm going to quit now? Do you remember any such instance?
Well, it happened in my first venture, not in this one.
Not in this one?
Not in this one. Because
no
I faced
challenge big enough that you couldn't solve.
Yeah, I mean, because I think, look, when in the first venture I saw .com burst in 2000, I saw 2007 the global financial crisis, and in this venture I also saw a couple of crises that we saw in 2013, 2016, some fundraising cycles that go up and down. But I think it made us strong in that first venture, so very, very strong. Funding cycles come and go. We have not raised primary for last 5 years. This will be our first primary raise after many years. And
are you a bit disappointed with the valuation at $2.8 billion? It's unchanged from the last round.
Look, valuations and all of these are a function. We met a lot of public market investors, domestic institutional investors, foreign institutional investors. Quite a lot of them, and especially all from the public side, and we got their perspectives. Our banking partners, BRLMs, have collated all the sort of data
but you're
points from
hoping
them.
for a push towards 3.5.
Well, it doesn't matter. We are here for long. It doesn't matter, and we feel that price discovery was a proper process. It's a process that BRLMs conduct on the behalf of the board. And we met in the process some very exciting institutional, domestic and foreign investors, and we feel my eyes were also opened when we met so many of them, because typically we have met only private equity investors in our past, but this time around we met a lot of public market investors, domestic and foreign, learned their perspectives, learned their journeys as well, how institutions have been built, and it was very exciting. In our journey of many years, there's nothing to disappoint, and it's an exciting moment for all of us, and for all our stakeholders, shareholders, customers as well. I would say that they'll feel so proud to be associated with us, having trusted with us for buying products, relying on our content, community, India, international, and so on and so forth. We feel we'll continue to make them proud and make India proud as well.
Thank you, Supam. This has been a great conversation. Wish you all the best. It's a big milestone for you, your family, and the entire team at FirstCry.
Thank you. Thank you, Reema. Thank you very much.